When people talk about all-in-one growth portfolios, Vanguard and iShares usually steal the spotlight. But there is a third player in the room that has been quietly winning over fee-conscious investors, ZGRO. This is BMO's answer to the 80-20 growth split. It's making a serious case for being the best of the bunch. While everyone else arguing over VGRO and XGRO, savvy investors are looking at BMO ZGRO for its competitive fees and unique made-in-Canada approach. But look, is it just a clone of others, or does BMO have a secret sauce that makes this a better core holding? Today we're breaking down the ZGRO holdings, explaining the mysterious ZGRO versus ZGRO.T difference, and seeing if this ETF deserves a spot in your portfolio. So without further ado, let's get right into it. First, let's answer the big one. What is ZGRO? Technically known as the BMO Growth ETF, this is an all-in-one solution that automatically balances your money between 80% stocks and 20% bonds. Just like its rivals, it's a fund of funds, meaning when you buy ZGRO, you're actually holding a basket of other BMO ETFs that cover Canada, the US, and the rest of the world. The ZGRO stock price is listed in Canadian dollars, which makes it a breeze to buy inside your TFSA or RSP without paying the FX fee. BMO designed this fund for the growth investors. Someone who wants the high-octane returns of the stock market but still want a 20% bond cushion or ballast to keep the ship steady when the markets get very choppy. It's a complete diversified portfolio that rebalances itself, so you never have to actually do the math yourself. But let's look at its comparison to other ETFs now. When you run a ZGRO compare against the big two, the differences are small, very small I would say, but it's still worth noting them. The ZGRO MER currently sits at 0.2%, which is identical to XGRO, and is actually a bit cheaper than VGRO 0.24%. Now while the 4 basis points in this example might not seem like much, over 30 years of compounding, those savings stay in your pocket rather than fund managers and accumulate. The difference here is the flavor of the holdings. ZGRO BMO tends to have a slightly different demographic mix. While VGRO is very heavy on the US and XGRO leans into certain sectors very heavily, ZGRO uses BMO's own highly rated S&P 500 and TSX composite fund. Many investors prefer ZGRO because of BMO's bond desk is legendary, pretty legendary in Canada, and they trust the fixed income portion of this fund, like the ZGRO ETF, to be top tier when the economy slows down. So what's this T factor that people talk about when they mention ZGRO? If you've searched for this fund, you've probably seen the ZGRO.T pop up and you wonder what happened to the regular version. And don't worry, nothing happened to it. There are just two different versions of the same fund. The regular ZGRO dividend pays out quarterly and is focused on growing your wealth. However, ZGRO.T is the T-series version specifically designed for retirees. It pays a fixed 6% annual distribution, which is distributed monthly, by dipping into capital gains and return of capital. So I would say use ZGRO if you're in the accumulation phase and want to grow your money, and use ZGRO.T or ZGRO.T if you're retired and want a steady, predictable monthly paycheck hitting your bank account. Now let's talk about the dividends. For the regular version, the ZGRO dividend yield is typically around 1.7 to 2.2%, depending on the year. Because BMO holds dividend-paying giants like the big 5 banks and Apple, you get a consistent stream of cash. These payments hit your account every 3 months, usually in early January, April, July, and October. And one of the biggest perks of BMO ZGRO is how easy it is to set up a DRIP. If you use a major Canadian broker like Simple or Questrade, you can have those quarterly payouts automatically buy more shares of ZGRO at the current ZGRO prices. And this is the ultimate set it and forget it strategy because it ensures you're always buying more of the world's best companies without even really thinking about it. So, who should choose ZGRO? Let's take a look. Is ZGRO the right choice for you specifically? I would say if you're a fan of BMO's banking stability and you want a low-fee, growth-oriented portfolio, it's a pretty good pick. I'm going to say choose ZGRO if you want a 20% bond cushion, you want the lowest possible MER, and you prefer BMO's specific selection of underlying ETFs and holdings. Then I'm going to say choose VGRO If you're a Vanguard fan or loyalist, whatever you want to call it, and you prefer their slightly different international weighing. And lastly, I would say choose ZGRO.T or ZGRO.T if you're nearing retirement and you specifically need the steady 6% monthly cash flow. So don't expect a lot of growth, but expect a good monthly cash flow. Anyways, guys, thank you so much for watching the video once again. And just a quick heads up before we wrap up here, this video is for educational purposes only. I'm not a financial advisor, just a guy sharing my own research, my own opinions, so please do your own homework. Talk to a professional before moving your money around. That said, if you enjoyed the video, please hit that like button and subscribe to the channel. It really helps YouTube algorithm realize that these videos are at least somewhat watchable for my Canadian audience and that I'm actually bringing a small amount of value to the personal finance community. Anyways, once again, thank you guys for the support and I'll see you in the next one. Take care.